For more than 3 years, people have been asking the same question. When is the housing market finally going to crash? Despite mortgage rates doubling, despite affordability collapsing, and despite home sales falling to levels we haven't seen in decades, the crash never came. So were they wrong? Or have we simply been comparing today's housing market to the wrong chapter in history? The housing market feels broken. Home prices exploded. Mortgage rates have doubled. Affordability deteriorated faster than many people expected. And yet, the massive housing crash so many people predicted still hasn't happened. Millions of buyers today are stuck in a strange position, waiting, watching, hoping prices fall enough for housing to finally become affordable again. But there's one major problem with that mindset. Many people are comparing today's market to 2008 without realizing how fundamentally different today's market actually is. Because while today's housing market absolutely has pressure, pressure and collapse are not the same thing. So to understand where we are today, we first have to understand how we got here. We're going to compare the 2008 housing crash to the extraordinary housing boom of 2020 through 2022 and the frozen market we're living in today. Because once you understand what actually drove each cycle, today's market starts making a whole lot more sense. To understand why today's market feels so confusing, we have to go back to the last major housing collapse in America. Because 2008 wasn't simply a housing downturn, it was a credit crisis, and that distinction changes everything. Leading up to 2008, housing demand wasn't being driven by strong financial fundamentals. It was being fueled by easy money. Banks were approving loans for borrowers who often couldn't realistically afford them. Adjustable rate mortgages became common. Speculative investing exploded. Construction surged. Credit standards became dangerously loose. For a while, rising home prices hid the risk. As long as prices kept climbing, everybody believed the system was working. But underneath the surface, the foundation was becoming weaker every day. Eventually, adjustable rate payments reset. Many homeowners could no longer afford their payments. Defaults increased. Foreclosures surged. Inventory flooded the market. And that's the key difference. The 2008 crash wasn't simply caused by high prices. It was driven by forced selling at an enormous scale. The market didn't slowly cool, it unraveled. And that's important because the housing market that emerged from 2020 was almost the complete opposite. Instead of too much supply chasing weak buyers, we suddenly had too many buyers chasing too few homes. When the pandemic began in 2020, many economists expected housing to weaken dramatically. But instead, the exact opposite happened. In hindsight, it seems obvious at the time. Almost nobody predicted what came next. Mortgage rates fell to historic lows. Stimulus injected enormous amounts of money into the economy. Remote work completely changed where people wanted to live. Millions of millennials entered their prime home buying years. Demand exploded overnight. But there was another problem. The housing market entered the pandemic already undersupplied. Following the 2008 crash, builders spent years constructing fewer homes than the population growth demanded. So, when demand suddenly surged, inventory supply couldn't keep up. That imbalance created one of the most aggressive housing markets in modern history. Bidding wars became normal. Buyers waived inspections. People offered well above asking price. I actually remember working with one buyer during the height of the frenzy who spent nearly 6 months trying to get an offer accepted. At one point, they offered $20,000 above asking price. They were willing to waive the appraisal gap. Still lost. That's how competitive the market became. People weren't simply buying homes anymore. They were competing against fear, scarcity, and the belief that if they didn't buy immediately, they might never catch up. Investors entered the market. Migration accelerated into states like Florida. And psychologically, fear of missing out became one of the biggest drivers of demand. This wasn't a credit bubble like 2008. It was a supply and demand shock fueled by historically cheap money. But eventually, the same thing that helped create the boom began slowing it down: interest rates. When the mortgage rate surged, housing affordability deteriorated incredibly fast. Monthly payments skyrocketed. Demand slowed dramatically. But then something happened that surprised many people. Inventory didn't explode. Why? Because millions of homeowners became locked into historically low mortgage rates. Think about it. If someone bought a home with a 2.5 or 3% mortgage, selling today could mean doubling their monthly payment just to buy another similar home. So instead of listing their homes, many simply stayed put. And that created what many analysts now call a frozen housing market. Buyers don't want today's rates. Sellers don't want to give up yesterday's rates. In many ways, today's housing market isn't stuck because nobody wants to move. It's stuck because nobody wants to lose what they already have. At the same time, today's homeowners have substantially more equity than homeowners had before the 2008 crash. Lending standards are stronger. Fixed rate mortgages are far more common, and despite affordability challenges, we still haven't seen the widespread forced selling that defined 2008. That doesn't mean prices can't decline. Some already have, but today's market is structurally different. And that's why local markets matter so much. We saw this firsthand here in Florida. Markets that experienced massive migration during the pandemic often behave very differently from areas with slower population growth. That's why national headlines don't always reflect what's happening in your neighborhood. Real estate is national in trend, but deeply local in behavior. So why are so many buyers still sitting on the sidelines? Because they're not just waiting for lower prices. They're waiting for certainty, waiting for mortgage rates to fall, waiting for headlines to improve, waiting for the perfect moment. And psychologically, many people are still anchored to 2008. Major financial crises leave emotional scars, but markets rarely repeat themselves exactly. One of the biggest misconceptions today is believing that affordability problems automatically create housing crashes. Sometimes markets crash because of excessive debt. Sometimes they stagnate because financing becomes expensive. Sometimes they simply freeze. And today's market may end up looking more like a prolonged affordability problem than a dramatic collapse. Part of the challenge is that there's always noise. For the past 3 years, someone has always been predicting a housing crash almost every single month. The reality is, predicting a crash every year isn't forecasting. Eventually, it's just waiting long enough for something to go wrong. Housing markets move through cycles: seasonality, demographics, employment, migration, local supply, not headlines alone. That's why understanding the numbers is far more valuable than trying to predict the day the market turns. History shows us something fascinating. Markets often become the most confusing right when people expect certainty. Ask yourself something. If mortgage rates suddenly dropped back to 4% tomorrow, would you still be waiting for the housing crash? Or would you suddenly feel more comfortable buying? Because for many people, the obstacle isn't simply affordability, it's uncertainty. Could housing prices fall from here? Absolutely. Some markets already have. But that's not the real question. The real question is whether the ingredients exist for a nationwide collapse similar to 2008. For something like that to happen, we would likely need a major rise in unemployment, widespread forced selling, serious credit stress, and significant surge in inventory. Historically, large housing crashes required distress entering the system. Today's market certainly has pressure, but pressure and distress are not the same thing. A more likely scenario could be a slower reset, flat prices, slower sales, localized corrections, and affordability gradually improving through some combination of wage growth, lower rates, increased inventory, and simply time. That may not be exciting, but it's a realistic possibility. And for many people, the better question isn't, can I perfectly time the market? The better question is, does buying make sense for my financial stability, my time horizon, and my long term goals? Because trying to perfectly predict every market move is much easier in hindsight than it is in real life. And if history teaches us anything, is that markets have a way of humbling people who become too confident in their predictions. At the beginning of this video, I asked whether we're comparing today's housing market to the wrong chapter in history. Personally, I think we are. Not because housing prices can't decline, not because every market is healthy, but because understanding why markets move is far more valuable than trying to predict exactly when they'll move. If I had to summarize the biggest difference between 2008 and today in one sentence, it would be this. 2008 was a housing market overwhelmed by forced sellers. Today's housing market is constrained by reluctant sellers. And that single difference changes almost everything. The biggest mistake buyers, investors, and even commentators make is assuming every housing cycle ends the same way. History rarely repeats itself perfectly, but it often rhymes. And right now, I think many people are listening to the wrong rhyme. Whether you're planning to buy, sell, invest, or simply understand what's happening, ignore the noise, study the numbers, understand your local market, and make decisions based on your financial situation, not someone else's predictions. If you found this analysis valuable, let me know down in the comments. Do you think we're headed towards a major housing crash, a slow reset, or something completely different? I'd love to hear your perspective. Thank you for watching Francisco's Key Insights. I'll see you next time.